Thank you very much for a very nice introduction. Good afternoon to all of you here in person, and as well, good afternoon to all of you online. My name is Eva Mikrašová, and I am head of ETF Business Austria and CE at Invesco. We as Invesco, it's our pleasure to be here today as a main partner, and we're really looking forward to speak to all of you during the coffee breaks. Before I start to talk a little bit more about ETF costs and application methods, let me introduce Invesco as a company. Invesco is a global, leading and independent investment firm with over $1.4 trillion asset under management. We managed active mutual funds, solutions, mandates, and of course, ETFs. Regarding our ETF business, we are the fourth largest ETF player globally, with over 400 ETFs available on the market. Did you actually know that in January this year, we celebrated 30-year anniversary since the first American ETF? Since then, a lot has happened in the global ETF market. Looking at the left-hand chart, global ETF market has been growing rapidly over the last 10 years. Now we have, by end of 2022, over $9 trillion asset under management. So, which means global ETF market has doubled more than every 4 to 5 years. Looking at the middle chart, EMEA ETF market has been growing as well rapidly over the last couple of years. 2021 was a record year regarding net new assets in the EMEA UCITS ETFs, with almost $200 billion. 2022, despite the turbulent market, is still pretty good regarding net new assets into the EMEA UCITS ETFs, amounted to $87 billion. And since beginning of the year till 20th of April, we saw inflows of $51.7 billion in EMEA UCITS ETF market. And from that number, around 17% went into global equity ETFs, 18% in emerging market ETFs, and then around 13.5% in European corporate bond ETFs, and over 9% in single and broad commodities. So now looking at the right-hand chart, according to the asset classes, obviously, equity ETFs are the biggest part with 68% asset under management. On the second place is fixed income ETFs, which is with 24%, and commodities are with 8%. Now let's talk a little bit about costs. Because we know, all of you here, that ETFs is the new modern structure, which is very cost efficient. And the total cost of ownership by investing to ETFs, we can split them to two main costs. The first one are holding period costs. The second one are implementation costs. So holding period costs. These costs are relevant for all investors, actually, since the moment you are already invested till the moment you decided to get rid of your ETFs. So these are the most popular: management fee, ongoing charges, tracking error, rebalancing costs, swap fees, taxes, and so on. Then the second cost, which is as well as important as the first cost, are implementation costs. So typical trading costs, how to enter ETF and how to efficiently exit the ETF. And these costs could do as well huge difference by investing to an ETF. And this is very important to us at Invesco to support our investors, our clients, by entering and exiting our products, by preparing pre-trade analysis for them, looking at the quotes, because the trading of UCITS ETFs in Europe is a little bit different to trading the US ETFs, because majority of the trades are not on the stock exchange, so are then OTC via the market makers or APs. So it is important for us to support our clients to get them the best and most efficient quotes. And for investors who are investing long-term into ETFs, obviously the holding period costs are more important, but for the traders who are trading pretty frequently, are the implementation costs more important. So let's talk a little bit now about the holding periods costs. What is the true cost of the replication? The first one, pretty obvious one, are the management fee and ongoing charges. So these are the one you are probably looking at by selecting an ETF. These include like management fees, custody fees, admin costs, and so on. But these are not all potential costs. Then the second one are transaction costs regarding the rebalancing of the ETF, probably swap fees, and this could have large impact and are not included in the ongoing charges. Then obviously tracking error, so which is how consistently an ETF tracks the index. And then withholding tax rates cost. And this one are for a lot of investors still not very familiar. And this is why I would like to talk today mainly about these kind of costs by investing into ETFs. And with that one, when you have lower than standard withholding taxes on dividends, which are obtained by the fund, it can lead to outperformance. And this outperformance could be around 40 basis points, which shouldn't be ignored because it's a lot. And then, of course, at the end, stock lending revenue, which can improve the performance of the ETF. Now, let's look at the withholding tax costs with one example, S&P 500 index. So usually when you invest or when investor invests into US ETFs, the ETFs which are tracking US regions like S&P 500 or MSCI USA, NASDAQ 100, or so on. So the withholding taxes on dividends are automatically deducted by investing in the net return index or indices. And the standard net return index assumes 30% of withholding taxes on dividends received by the funds. So, and you have now actually two ways how to manage these costs and how to decrease this cost connected to these withholding taxes on dividends. The first one is domicile of the ETF. So you can select the right domicile and you can actually decrease the costs. And the second one is the selecting right replication method by selecting an ETF. Let me first talk a little bit about the domicile. So the domicile you can easily identify by looking at the ISIN of the ETF, and specifically Irish domicile funds only pays 15% withholding taxes on dividends, which is half of the original 30% because of the US-Irish tax treaty. So just by selecting Irish domiciled, for example, S&P 500 ETFs physically replicated, you can already actually save half of the withholding tax. And let's look at this on the right-hand chart. So what you can see here is graphically what actually it means for your performance. So calculated to 0, you can see S&P 500 net index. Then we actually created this index with 15% tax, which is with the blue line. And then we took two physical UCITS ETFs, which are the biggest on the market from the largest ETF providers on the market. And what you can see here, that this physical replicated ETFs with Irish domicile and the 15% net index is outperforming S&P net return index, just by selecting the right domicile. What it means for performance, so performance-wise, you can actually save around 20 basis points. So outperform the net return index by 20 basis points. Now let's look at the second option, how investors can manage withholding tax discounts, how they can decrease the cost. The second one is by selecting the right replication method. And the replication method called synthetic replication. We call it an Invesco physical replication with swap overlay. So what does this mean? With this replication method, you can actually decrease the withholding tax cost to 0. From 30% to 15% by Irish domiciled and to 0 by selecting synthetically replicated ETFs. So let's look at straight to the chart on the left-hand side. What you can see here again is S&P net return index. Then you see the 15% tax net index. And then you see 3 synthetic replicated ETFs from the largest providers, the largest on the market. And obviously you can see that the 15% net return index outperformed the S&P net return index, and all the synthetic ETFs are outperforming then the 15% net return index because of the replication method. You see, of course, the differences between the ETFs. You see that ongoing charges are a little bit different. The tracking error is as well very low. So it makes difference to select by which asset manager you select the synthetic replicated ETFs, because every asset manager have different costs, have different little bit structure, different tracking error, and so on. And what you can see now, the exact calculation, how we actually calculate how much you can save on these withholding taxes. You can see it here on the right-hand chart. So let's assume that the dividend yield is 1.68%. Then the standard withholding tax is 30%. So you calculate actually that without any costs, you can save 51 basis points. Then you deduct the cost, you deduct the ongoing charge, you deduct the swap fee, and actually your outperformance between the net return index is 42 basis points. And 42 basis points by S&P 500 index is a lot when you compare that the fees by S&P 500 are around 5 to 7 bips. Now is the question, so okay, understand, but why? By the Irish domiciled, the question is clear. There is this US-Irish tax treaty. That's the reason. So how it is with this synthetic replicated ETF? There is not anymore very new, but still not very familiar regulation for a lot of investors, so-called HIRE Act 871M in US. And this HIRE Act made clear that all swaps which are written on indices with liquid futures market are exempt from withholding taxes. Maybe I can tell you a little bit brief background about this regulation. So this regulation is valid since 2017. And in the past, obviously, you don't pay any taxes, withholding taxes on dividends when you are using futures. But in the past, you had to pay the taxes by using swaps. And the US regulation wanted to make this tax regulation fair. That's why they decided that as well swaps, which are OTC derivative contracts, are exempt from the withholding tax on dividends. So this is the reason why actually synthetic replicated ETFs are exempt completely from the withholding tax. And obviously, the synthetic replicated ETFs, they consist of the basket of securities, and the index performance is swapped with the basket of security. And that is where the swap is used by this replication structure. I will talk about this in a couple of seconds. So now, how synthetic replicated ETF works. So we know what are the benefits now. So let's look at how this works, because physically replicated ETFs is pretty clear how that one works. So the first step, and now just a note to this, I am now going to describe the process we are using at Invesco. And I would like to as well stress that every asset manager have a little bit different process, different risk management, different management of counterparty risk, different basket compositions, and so on. So today I will introduce what we are doing at Invesco. So the first step, what we are doing, is that ETF owns actually a basket of high-quality developed market securities. And this basket doesn't have to be exactly the same as the index ETFs is tracking, which means you can have in the basket a little bit different composition of the stocks, the weights could be different. Which is important to us at Invesco is that the basket has high-quality stocks which are liquid, and all the stocks have to be listed on the stock exchange. And we are looking at the, first of all, correlations. So the basket have to have a very high correlation to underlying index. The second, diversification. The basket follows usage rules. The third, concentration limits. We are really looking at that we don't have any concentrated positions in the basket to manage the concentration risks. And the last one, very important, liquidity. That the stocks are liquid, are listed on the stock exchange. Then we have the basket, which is not exactly the same as the underlying index, but we need the performance of the index. So what we do as a second step, we swap the performance with total return swap with investment bank, which means we are sending performance of the basket to the investment bank, and the investment bank is sending us the performance of the index. What it means, then as you include investment bank to your formula, you have kind of counterparty risk. And it is very important and crucial to manage this risk. What we are doing here, how we manage this, is that we use multi-swap counterparties. That we don't rely just on one bank, we are using a couple of banks. And it is usually, depending on the ETF, it is between 4 to 6 investment banks. There is a committee at Invesco who is selecting which investment bank have a contract with us. There is credit assessment of the investment banks. So we are looking at the Standard & Poor's, Fitch, and so on, ratings agency. It has to have rating A2. And we are doing continuously credit assessment and ratings of the investment banks. And at the end, we can achieve very precise replication and then minimal counterparty risk, because usually in the market, when the volatile are not too high, we have around 99% in the physical basket of the securities. Around 1% is this total return swap. And this 1% total return swap is split into 4 to 6 counterparties, which makes around 0.2% counterparty risk per one counterparty. But the risk management and the risk mitigation goes further in the process. So after we select the banks, do the credit quality check, after we make sure that the banks are diversified, then actually the question is, when the ETFs have this slight counterparty risk? And it is only in the case when the index owns us performance. Because when the basket is outperforming the index, then we own money to investment bank, no problem at all for us. And statistically, it is like 50-50. 50% of the time, we own the performance, 50% of the time, plus minus, bank own us performance. Which means, in the 50% of the times, we need to make sure that the counterparty is delivering us performance. And when actually we have the risk, it is in the time when the swap has mark-to-market value. This is why it's very important to have very strict reset criteria. And we identified following limits. So first of all, exposure to a swap counterparty is resetted when the nominal value is 400,000 euro, then or 0.2 of fund assets, or 4.5 of swap notional. These are very strict criteria. The second, then, when there is some creation or redemption mechanism in place, or when the markets are very, very calm, and after 30 days pass since last reset. And here, because I mentioned the calm period, no volatility in the market, no problem, we are showing you here an example of the volatility, of the volatile markets, what's going on with the swap mark-to-market value when the markets are a little bit more volatile. And here you can see the example of the first quarter 2022 during the shock of the COVID pandemic. You can remember the markets been dropping down and then recovering pretty quickly. So here you can see the first quarter of the mark-to-market value. So what you can see here with the dark blue line is regulatory limit, what is the maximum of the swap notional product could have, which is 5%. Then you can see this, what I already mentioned, this 4.5, our limit, what is the swap notional. And I mentioned that usually the swap notional is around 1%, but when the markets get volatile, and during the first quarter of the COVID pandemics, it was 2.5%. Still much below the limit we have set up. And the second important information is as well that at least 3 of the 4 counterparties rested on almost all days, but on 5, in the first quarter, the swaps. So, bottom line, it went pretty smoothly. And to summarize this, okay, so for me as an investor, it is pretty attractive risk-reward because I can earn actually 40 basis points in comparison to net return index, depending on the dividend and on the index. Let's assume this S&P 500 net return index example. And I'm taking slight counterparty risk. So what is the worst case, really like the worst case scenario, what can happen to me? So first step is that actually all the banks get bust. And imagine what happened when Goldman Sachs, JP Morgan, Morgan Stanley, and this bank collapse. I think then we have completely different problems than the replication method. The second is that the swap is not resetted. And there are very strict criteria that the swaps are resetted. So as soon as you reset swap, you don't have any risk anymore. Swap needs to, again, have the mark-to-market value. And then actually you end up with a basket of physical stocks, which is correlated to the underlying index and so on. So your risk is actually that your tracking error increase. That's the other risk you are actually taking. And in case that something happened on the market, some unimaginable scenario that the synthetic replication is not possible, then we can switch to physical replication. I mentioned S&P 500 as a main index to actually make my point during this presentation. But it is not just S&P 500. I told you that this tax regulation in US is for every liquid, deep future market. So as well for MSCI USA, you see the same, that the synthetic replicated ETFs outperform the physical one and the net return index. The same for S&P 500 ESG, or S&P 500, S&P 600, as well even for MSCI World, because you have still around 60% in US, in that index. Even for NASDAQ. And you can see here that, again, you have here physically replicated NASDAQ 100 ETFs, then you have a couple of synthetically replicated NASDAQ 100 ETFs, and then you have the NASDAQ 100 Net Total Return Index. And as the NASDAQ is a little bit more expensive product, so the ETFs usually cost between 20 to 30 basis points. So here actually, by selecting the synthetic replication method, you can pay for your costs, what you are actually paying for the NASDAQ 100. And to finalize my presentation today, I would like to maybe mention a couple of points why Invesco is a good partner for the synthetic replicated ETFs. The first reason is that we have more than 10-year history in synthetic replication and expertise. Second, we capture major inflows into synthetic replicated ETFs, and we have actually the largest UCITS S&P 500 index replicated ETFs synthetically on the market. And we have very strict counterparty risk management risk criteria, strict swap reset criteria, very strict basket composition, so the risks are very well managed. And at the end, we have over 60 synthetic replicated UCITS ETF on the market. And with that, thank you.